Hello, I'm Christine Lu, a manager at Zeifmans. Welcome to Zeifmans Non-Resident Digital Event Series, High Net Worth Edition, Legacy, Preservation, and Optimization. Before we begin our interview session with Jonah Mayles, TEP Partner at Sterling Pop Financial Group, I would like to quickly tell you a little bit about Zeifmans. Zeifmans is a full-service tax, accounting, and consulting firm based in Toronto, Canada. As an owner-operated, family-run business, now in its third generation, we have a unique understanding of the needs of entrepreneurs, and our knowledgeable partners are prepared to help build your wealth throughout your lifetime and beyond. Please feel free to ask questions, and we will try to address as many as we can at the end of the interview. With that, I'd like to officially introduce to today's final guest, Jonah Mayles. Hi, Jonah. Tell us a little bit about you and what you do.
I am the tax and estate planning partner at Sterling Park Financial Group. We are a tax and estate insurance advisory firm. While we work with clients, across the spectrum, we do specialize in high net worth and ultra high net worth. A lot of our planning involves the use of insurance as a tax planning tool. And we do work with non-residents on occasion. So I'm happy to be here and talk about it because it is a complicated way to do insurance here in Canada when you're dealing with someone who doesn't live here on a regular basis.
Mm-hmm. Yeah, awesome. So I have a few questions for you today. So our topic for today is for non-resident. How does insuring a non-resident in Canada work? How do you set up in Canadian insurance for a non-resident?
I mean, it is actually a very difficult thing to do. On the onset, if you are not a resident here, the default of an insurance company is to not provide you with insurance. So, I mean, we don't want to end the discussion there, but there are exceptions that can be made. Typically, that goes in two buckets, either business or personal. Often engaged by lawyers to deal with the business side, and that is a non-resident that has an interest in a business or a partnership here. A business use for insurance, which is term insurance, and it's typically to fund the buy-sell of an agreement, whether that's a partnership or corporation. If you have if someone owns part of a partnership or corp and they pass away and the surviving shareholders want to buy those shares, insurance is often used to fund that. So we need to get insurance on all the shareholders, whether they live here or not. We have been successful in getting insurance for individuals that do not live here in cases like that. But again, we need to provide that, the structure of that to the insurance provider beforehand, or they will be rejected. Another important thing there is, there are many types of insurance, but I'll talk about the two main types, which is whole life insurance and term insurance. Anytime you're dealing with an individual that is not resident here, we have to talk about tax, because the tax here is far different from the tax anywhere they come from. It doesn't matter what part of the world. There is a complication there because the tax rules are going to be different based on how insurance is taxed here and where they come from. Term insurance is the simplest way because there's no cash component in term insurance, and you are alleviating a lot of the concerns in taxation when you're talking about term insurance. Particularly when we're talking about a business need, term insurance is usually, it does the trick. We don't need to insure the if someone has an interest in a business, we don't need insurance for 40 years. It's typically, 10 or 20, they've invested in a startup and there's an exit to that. So we just insure for that time. So typically that's what it's done on the business side. On the personal side, we've done insurance for someone who's not a resident here in two cases. One is an athlete, which we've done a fair amount on, which is also kind of tricky in that an athlete can come here, play hockey, baseball, or basketball, whatever it is. They have no idea how long they're going to be here for. But they move here and they bring their families here. And if something should happen to them while they're playing sports here, insurance, is important for that. Often we have to get insurance for an athlete that isn't, they don't know how long they're going to be here for. It could be a year or 10 years or for life. We start with term insurance again because of taxation and deal with it thereon. A tricky thing for athletes, and this is something that happens in our business far too frequently, which is they get whole life insurance. And in whole life insurance, there's that cash value as part of that insurance. We have immigration tax here, which a lot of places do not have. When you leave here, you might have to pay tax. So you come here, you play sports for 5-10 years, you get your insurance, and then you get traded, or you retire and you leave and you go back to where you came from, and you might have an immigration tax. A personally owned policy is excluded from that tax, but if you put that policy in a company, which many people do, it can be taxable, and that's something else that has to be looked at, before you put it in place. The next type of personal type of insurance that we've gotten is there are people that, while they don't stay here full time, they might send their kids to live here full time. Their kids might become full time here, or they might be here on a visa, whether that's for school or temporary work. We can get insurance in that case as well, even though they're not here full time. If mom and dad, and this has happened to a client of ours, mom and dad sent their kids to live here, and the grandparents came to live with the kids to take care of them. The parents had a business elsewhere in the world, and that's where their focus was, and they would come in and out of here to see their kids, of course, but they weren't full-time here. We were able to get an exception and get them insured on their life, and the beneficiary of which were the kids. And I believe you asked, how do you do life insurance here for someone who isn't full time here? And that, again, can be tricky because of tax. And the tax rules are very different. You can take the U.S. In the U.S., most people do not own insurance inside a corporation because that is an incident of ownership. And that is the key phrase when determining estate taxes in the U.S. So when we're talking about people who might have their kids here or an interest here, having a policy inside a corporation might be a problem for estate taxes or taxes elsewhere in the world. The use of trusts really becomes very key when we're talking about insuring someone who is not a resident here at the time. A trust is the easiest way to ensure that the insured does not have an incident of ownership of the policy. And as long as the trustees of the trust are residents here, the trust is a resident here. And it makes everything far simpler from an underwriting and tax perspective to do it in that manner.
That sounds a little bit complicated for me. We definitely need expert on this.
The hard thing is that it depends where the individual is from. And we in the business, we can't profess to be experts in every country on insurance and taxation. We have to become an expert when the client comes to us, and we learn the hard way, I'll say, because we have to learn as we're working with the client. But my firm has worked with people from around the world in instances like that. And again, it's always important to understand that we're not just dealing with insurance, we're dealing with insurance and with tax. And anytime you're dealing with those things, you should never just engage us or your lawyer here. There always has to be a conversation with your advisors from wherever you come from, because I don't want to express my opinion on a law in a place I'm not licensed to practice. So that's always part of it. And you're right, it is complicated, messy. And I'll probably go grayer working with clients that aren't residents here than it would if not.
Okay, so as a non-resident, how do you assure that you receive the proceeds of your insurance when you live outside of Canada?
So this is a different question, because the first question was about how do you get insurance, which is typically about the insured, the residents of the insured. But now we're talking about the residents of the beneficiary, which is very different. And, you know, of all the clients we work with, it's rare to work with a client that's not a resident here. However, it's not rare where we are dealing with a resident here that has a beneficiary that is a non-resident. It happens all the time, particularly in the U.S. I mean, a lot of our clients, I shouldn't say a lot, a fair amount of our clients, their kids go to school in the U.S. Perhaps they find a job there. Perhaps they get married and stay. And, you know, we're seeing this around the world on a larger scale now, where kids are going to school elsewhere and working elsewhere, and they are the beneficiaries of the policies. So we deal with this on a regular basis, I would say, and it's not an issue. The issue becomes are you keeping up to date with, you know, is there a change? So if there's a change with a beneficiary, it's always best for the insurance advisor, the accountant, the lawyer, everyone involved in the estate to understand where they're from and to inform the company that has insured you as well. And typically that happens at the date of death, but getting the money to flow from a policy here to someone who doesn't live here is not an issue. You said the last one was complicated, and I hate to throw a wrench in this as well. All that changes when we are talking about a policy owned by a Canadian corporation. The reason being is the biggest benefit of a corporate-owned policy here is the benefits of taxation. It grows tax-free inside the corp, and the capital dividend count builds over time. And that's how so the insured dies, insurance flows into the corp, and then it can flow out tax-free. And that's the thing. But for that ability to happen, for the money to flow from the corp to a shareholder tax-free, the shareholder has to be a resident here, or that doesn't apply. And this happens more often than we'd like, where we see, let's say mom and dad, they set up a corp and they do an estate freeze. And as part of the freeze, the children subscribe for shares of that company. And just like I said, the kids can get married or take a job and move around the world. And we have this with the client. And the insurance cannot flow tax-free from the corp to that child that is no longer a resident here. What we do in this case is we try to work with the estate lawyers and do, an equalization. It's hard to say that word because things are never the same. But if you're dealing, this one particular client that I'm thinking of, they had an insurance policy of $3 million and 2 kids. Each kid was supposed to get $1.5 million. One child moved to New York for work, and we didn't want the tax hit of that money flowing to that child at that time. So what we did is we made sure we gave the child who lived here something called insurance tracking shares. And tracking shares, they track that policy insurance inside the corp. So when the insurance flows into the corporation, those shares are redeemed, and that money flows to that child who's resident here. The child who is resident in New York, some of the personal wealth held by mom and dad is going to go to that child to offset that balance. That the resident here gets $3 million of insurance, he gets none, so he's getting some of the inheritance that was held personally, because as per the treaty between us and the U.S., inheritance flow across the border completely tax-free. And this kind of goes to what I was saying at the front end, which is we are a tax, estate, and insurance advisory firm. The reason being is these things come up all the time, and to only know insurance, you wouldn't know that and how to deal with that. So we kind of have to think outside the box of just insurance and think about how it impacts the estate and taxes at the same time.
Okay, so here's another question. Why would a non-resident use a Canadian insurance provider rather than one from their own country?
That would only occur, and again, this doesn't happen very often, and it only happens when there's a purpose. So like I said on the first question, if there is a business purpose, a funding of an agreement between shareholders or partners, the insurance should be done here because the partnership or the company is resident here, or if you have kids here. If you have no nexus here, no footprint here, you would never get insurance here as opposed to live. First off, I don't think there's a point to it. I would be surprised if the products here are far superior than elsewhere around the world. But the insurance company here will not give you the insurance. And that is the key thing as well. You have to start with what is the reason why you're doing it, and there has to be some kind of footprint here in order to get the insurance in the first place.
Awesome. So what is the benefits of Canadian insurance versus offshore insurance?
By offshore, I'm assuming you just mean outside of here, not like offshore, like the Barbados or anything like that, just another country. I mean, so it kind of goes to corporate-owned insurance, which is something that I won't say is unique here because it happens elsewhere around the world, but in some places it doesn't happen. And the biggest example of that is the United States. In the United States, they have estate tax. And the way estate tax works is, if you own a company and you die, the value of that company is contributed to your estate tax as long as you own over 50% of that company.
Mm-hmm.
So if you had a corporate-owned life insurance in the US, that would actually be part of your estate tax. So you're creating this product, insurance is often used to either fund an estate tax bill or to create an estate. But if it's done the wrong way in the US, for example, you're actually contributing to your estate tax. Here, corporate-owned life insurance is hugely beneficial from a tax perspective. If you earn money in your corp and you're taxed anywhere from 13.5% to 26.5%, you have more after-tax dollars as opposed to getting taxed at 53.53%. You can then take that cheaper after-tax dollar, invest it in insurance, which means your return is higher because you've invested less. And then because of the capital dividend account, it can flow out completely tax-free. Mm-hmm. And that account is unique to here, to being a resident here. So that is, to me, the biggest benefit of being able to acquire a corporate-owned policy here is nothing to do with the insurance itself, that it's better than insurance you can get elsewhere in the world. It all has to do with how beneficial it is treated here from a tax perspective. And then anytime I have this conversation with an accountant or a lawyer or a client, they always say, well, could those tax rules change? Instead of owning corporate, and I don't have a crystal ball and I can't say what will happen from a tax perspective. And we are in very uncharted waters right now. And our clients are very concerned about what taxation in Canada is going to look like, because we're going to be in a pile of debt. And so how are we going to get out of that debt? There's two ways. You can, cut costs, which I don't think is going to happen, or increase taxes. And that's what likely is going to happen. And everyone assumes because this tax treatment is so good for insurance that perhaps the government is going to go and see what they can do on the taxation of insurance. My partners will laugh because I am a pessimist by nature. I like to think I'm a realist, but they like to think I'm a pessimist. I am optimistic about this one thing, which is I feel safe about the investment of insurance here, primarily because of what happened in 2017 when they introduced the tax rules that I thought were an attack on companies here, on small business owners. And after small business owners and tax professionals fought back, the government walked back on a lot of their proposals, and the teeth are not nearly as sharp as we thought. To go after insurance, and it doesn't matter if you're high net worth, ultra high net worth, middle class, or lower class, you are a widow or an orphan if you're receiving insurance. And it's hard for me to imagine a government being able to wage that PR battle going after widows and orphans, because that's what's going to be, and insurance companies and banks. I feel it's a very safe investment here, and I feel because of that, Canadian insurance has that benefit of its taxation here as opposed to the rest of the world.
Awesome. So how could a non-resident benefit from offshore insurance?
Again, that really goes to the purpose and the intent of getting the insurance. If we're talking about an individual that has a business here, so maybe they're looking at getting insurance here to protect that interest in the business or to fund an agreement, something like that, there's a need for it there. But if they are residents and their families live somewhere else in the world, that is where there's a case of there's a benefit for getting insurance where you live, and insurance here where you have an interest in a business. Again, it goes to what the purpose of insurance is, a business or personal, and where those interests live, here or elsewhere. So often when we're dealing with an individual that doesn't live here and we're working with them to get insurance here, we often end up advising them to get insurance where they come from as well, because it'll be for a completely different reason altogether.
Mm-hmm. Okay, so one last question for you. What issues are there for Americans in Canada getting insurance? And please explain how Canadian insurance is insured by the Canadian government.
So this is the one that we come across most frequently. We're dealing with a family right now where this is an issue. There are so many people who live here that are residents of Canada, let's say, but a citizen of the US. And the US, because they like to do everything different, they are the only Western country that taxes based on citizenship as opposed to residency. So because of that, we are often left in a position where someone could be taxed both here based on their residency and in the US based on their citizenship.
Mm-hmm.
So that's the first issue to deal with someone cross-border between here and the US. The second one is when that happens and we're dealing with the fact that there could be double taxation, the next thing is insurance is treated differently under the Tax Act here and the code in the US. And the most important thing when we're talking about a policy that has a cash value component to it and grows over time is that it's what's called the exempt test. And the exempt test here is a set of rules under the Act and the regs which state how a policy has to be built to be exempt from tax on the growth. So it's not taxed as the policy continues to grow. The equivalent of the exempt test in the US is different than the test here. So if you bought a policy here and you are a citizen of the US and you are a resident here, even on a temporary basis, there's a chance that that policy will not meet the test here and in the US, and you could be taxed in the US if it doesn't meet the exempt test. There are things you can do to mitigate that. So the first thing is you can actually engage someone to structure the policy in a way, and there are people who specialize in this, that meet the test both here and in the US. So that's the first thing that you can do. There's obviously a cost to it because you're paying someone for fees, and you might have to change that over time. It's a relatively small cost, so if we're talking about a large policy, that's not going to be an issue. And like I said before, corporate-owned insurance is not really a thing in the U.S. because of the state taxes. So what we often do when we're in this position is use what's called an irrevocable life insurance trust, or it's a trust that is formed for the sole being of holding insurance, and that's it. And when you have a trust that's in place for holding the insurance, one, we can make sure that there's no issues of double taxation, both here and south of the border, and we can ensure the biggest problem with life insurance in the U.S. estate tax. And I know Trump increased, that threshold of when estate tax is triggered. Who knows what happens in the craziness of the US, whether that exemption stays where it is or is reduced. Assuming Biden actually is president, I'll go crazy and make that assumption. He might reduce it back to the levels it was pre-Trump. But the thing about estate taxes is the policy, again, if not structured right, can contribute to your estate tax. And that would be, you are talking about a significant amount of tax on something that was created for your state, and now you're getting taxed because it's part of your estate. So that's where the trust comes into play as well. And the issue with the trust is often when people talk about estate tax, they have to talk about the U.S. gift tax as well, which is there's a limit of money that you're allowed to gift every year to get around the estate tax. Because if your estate tax threshold was $10 million, let's say you're taxed on every dollar above that, but you could gift that all in your lifetime to get around the estate tax, you would gift it all. So then the U.S. put in a rule where you can only gift a certain amount of money, which assures that you're not going to gift all of your wealth to your heirs and circumvent the estate tax. So if you set up a trust, you fund the insurance, to own the insurance, the question becomes, how much can you gift to the trust every year to fund the insurance. And then again, there are structures and things you have to do to get around the gift tax. So where the issues cross-border, you're talking about double taxation, estate tax, gift tax, and then the next fun part is ownership. Who owns the policy? And often this is something that we have to watch on a year-to-year basis because people move around a lot now. And an ownership structure that might work today may not work in 5 years. And moving a policy from place to place, from person to business, from business to person, from business to trust, and so forth, could trigger tax. And the main driver, the best benefit of insurance is taxation. You don't want to incur tax as you're trying to do tax planning. So anytime we're dealing with cross-border, we want to talk to like everyone, the mom, dad, kids, grandkids, everyone who's involved, to try to get a sense of where we think they might end up. We're dealing with a client now who moved from Canada to New York, who is now moving to the UK. And basically we put in a structure that's very fluid and flexible, where we're not going to trigger tax on all those moves. We're going to ensure that, you know, there's a trust in place and the trust is a resident here, and regardless of where they move, we're not going to trigger tax and everything will work as it should. But again, those are the things you have to look at, and that's why insurance most often shouldn't be sold as a product, but it really has to be done as part of advisory work because there are so many moving parts.
Awesome. Thank you so much. So any final words of advice for us today, Jonah?
I think that was actually good. That was my final word, which is, you know, there are a lot of moving parts, particularly when you're dealing with people that are moving around the world and have interest both here and abroad. It's important to look outside of just the insurance and think about the implications to the estate and to taxation, and to engage advisors not only here, where they are resident, and together to come.
Okay, so thank you for joining us today. So if you have any questions for Zeifmans, click the link in our bio and connect with us. Thank you again, Jonah.